Have you ever wondered what a credit score is and why it matters? In today's world, your credit score plays a crucial role in your financial life. Whether you're applying for a loan, renting an apartment, or even getting a new phone plan, your credit score can make a big difference. But what exactly is a credit score, and how does it work? In this video, we'll break down the basics, explain how scores are calculated, and show you why understanding your credit score is essential for your financial health. Let's get started by exploring the fundamentals. A credit score is a three-digit number that represents your creditworthiness. In simple terms, it's a way for lenders to assess how risky it might be to lend you money. The higher your score, the more likely you are to be approved for loans or credit cards, and often at better interest rates. Credit scores are calculated using information from your credit report, which tracks your borrowing and repayment history. Think of it as a snapshot of your financial reliability, used by banks, landlords, and even employers to make important decisions about you. Credit scores are more than just numbers. They can impact many aspects of your life. For example, a good credit score can help you qualify for a mortgage, car loan, or credit card with favorable terms. On the other hand, a low score might mean higher interest rates or even denial of credit. Some landlords check credit scores before renting out apartments, and certain employers may review them during the hiring process. Understanding your credit score gives you more control over your financial opportunities and helps you make smarter decisions. Credit scores typically range from 300 to 850. The higher your score, the better your credit standing. Generally, scores above 700 are considered good, while those below 600 may be seen as risky by lenders. This range helps lenders quickly evaluate your financial trustworthiness. It's important to know where you fall within this range, as it can affect the types of credit and interest rates available to you. Regularly checking your score can help you track your progress and spot any issues early. Credit scores are calculated by credit bureaus, also known as credit reporting agencies. The three major bureaus in the United States are Equifax, Experian, and TransUnion. Each bureau collects information about your credit activity, such as loans, credit cards, and payment history. They use this data to generate your credit report and calculate your score. While the scores from each bureau may differ slightly, they all follow similar principles. Knowing which agencies track your credit can help you stay informed and proactive. A credit report is a detailed record of your credit history. It includes information about your loans, credit cards, payment history, and any outstanding debts. Lenders use your credit report to assess your financial behavior and determine your credit score. Reviewing your credit report regularly is important because it helps you spot errors or signs of identity theft. By understanding what's in your report, you can take steps to improve your credit score over time. Credit scores are calculated using several factors from your credit report. The most common scoring model is FICO, which considers payment history, amounts owed, length of credit history, new credit, and types of credit used. Each factor has a different weight, with payment history being the most important. By understanding how these elements work together, you can make better choices to improve your score. Let's take a closer look at each factor and how it impacts your credit score. Payment history is the single most important factor in your credit score, making up about 35% of the total. It reflects whether you've paid your bills on time, including credit cards, loans, and other debts. Later missed payments can significantly lower your score, while a consistent record of on-time payments helps build a strong credit profile. If you want to improve your credit score, always aim to pay at least the minimum amount due by the deadline. The amounts you owe, especially on credit cards, account for about 30% of your credit score. This factor looks at your total debt and your credit utilization ratio, which is the percentage of your available credit you're using. Keeping your balances low compared to your credit limits shows lenders you're responsible with credit. Experts recommend keeping your utilization below 30% to maintain a healthy score. The length of your credit history makes up about 15% of your score. This factor considers how long your credit accounts have been open, including the age of your oldest account, the average age of all accounts, and how recently you've used them. A longer credit history generally helps your score, as it gives lenders more information about your borrowing habits. If possible, keep your oldest accounts open to maintain a strong credit profile. New credit accounts and recent inquiries make up about 10% of your credit score. When you apply for new credit, lenders perform a hard inquiry, which can temporarily lower your score. Opening several new accounts in a short period may signal risk to lenders. To protect your score, only apply for new credit when necessary and avoid multiple applications at once. The types of credit you use also influence your score, accounting for about 10%. Lenders like to see a mix of credit accounts, such as credit cards, mortgages, auto loans, and personal loans. Having different types of credit shows you can manage various financial responsibilities. However, don't open new accounts just to diversify, only take on credit you actually need. There are different credit scoring models, with FICO and VantageScore being the most common. Both use similar factors, but may weigh them differently or use slightly different data. Most lenders rely on FICO scores, but VantageScore is also widely used. It's helpful to know which score your lender uses, as your numbers may vary between models. Understanding these differences can help you better interpret your credit reports. Lenders use your credit score to decide whether to approve your application and what interest rate to offer. A higher score usually means better loan terms and lower interest rates, while a lower score can lead to higher costs or even denial. Lenders see your score as a quick summary of your financial reliability, helping them assess risk and make informed decisions. Your credit score directly impacts the interest rates you're offered. With a high score, you're more likely to qualify for lower rates, saving you money over time. Conversely, a low score can mean higher rates and greater costs. This is why maintaining a good credit score is so important. It can make a significant difference in your financial future. Landlords often check credit scores when you apply to rent an apartment. A good score can make it easier to get approved and may even help you negotiate better lease terms. If your score is low, you might need a cosigner or have to pay a higher security deposit. Being aware of your score before applying can help you prepare and avoid surprises. Some employers review credit reports as part of the hiring process, especially for jobs involving financial responsibility. While they don't see your actual score, they can view your credit history for signs of reliability. A clean credit report can give you an edge, while negative marks might raise questions. It's another reason to keep your credit in good shape. It's important to check your credit score regularly. Many banks, credit card companies, and online services offer free access to your score. Monitoring your score helps you track your progress, spot errors, and detect signs of identity theft early. Make it a habit to review your score at least a few times a year. You're entitled to a free credit report from each of the 3 major bureaus once a year. Visit annualcreditreport.com to request your reports. Reviewing your credit report lets you verify the information, dispute errors, and understand what lenders see. It's a key step in managing your financial health and protecting your credit score. There are many myths about credit scores. For example, checking your own score does not hurt it, and closing old accounts can sometimes lower your score. Another myth is that you need to carry a balance to build credit, but paying off your balance in full is actually better. Understanding the facts helps you make smarter financial choices. Improving your credit score takes time and discipline. Start by paying your bills on time, reducing your debt, and keeping your credit utilization low. Avoid opening too many new accounts at once, and check your credit report for errors. Over time, these habits can help you build a stronger credit profile and unlock better financial opportunities. Consistently paying your bills on time is the most effective way to boost your credit score. Set up reminders or automatic payments to avoid missing due dates. Even one late payment can have a negative impact, so make timely payments a top priority in your financial routine. Lowering your outstanding debt, especially on credit cards, can quickly improve your credit score. Focus on paying down high-interest balances first, and try to keep your credit utilization below 30%. As your balances decrease, your score will likely rise, making you more attractive to lenders. Applying for multiple credit accounts in a short time can lower your score. Each application triggers a hard inquiry, which may signal risk to lenders. Only apply for new credit when you truly need it, and space out your applications to protect your score. The age of your credit accounts affects your score. Closing old accounts can shorten your credit history and reduce your available credit, which may lower your score. Unless there's a good reason, keep your oldest accounts open to maintain a healthy credit profile. Mistakes on your credit report can hurt your score. If you find errors, such as incorrect balances or accounts you don't recognize, dispute them with the credit bureau. Correcting errors can quickly improve your score and ensure your report accurately reflects your financial history. If you're new to credit, start by opening a secured credit card or becoming an authorized user on someone else's account. Use your card responsibly, make small purchases, and pay off the balance each month. Over time, you'll build a positive credit history and establish a solid score. Becoming an authorized user on a trusted person's credit card can help you build credit. Their positive payment history will be added to your credit report, boosting your score. Just make sure the primary account holder uses the card responsibly, as negative activity can also affect your score. Secured credit cards are a great way to build or rebuild credit. They require a cash deposit as collateral, which becomes your credit limit. Use the card for small purchases and pay off the balance each month. Over time, responsible use can help you qualify for traditional credit cards and improve your score. Credit builder loans are designed to help people establish or improve their credit. Instead of receiving money upfront, you make monthly payments into a savings account. Once the loan is paid off, you get the money, and your positive payment history is reported to the credit bureaus. It's a safe way to build credit if you're just starting out. Tracking your credit score over time helps you see the impact of your financial habits. Many online tools and apps let you monitor your score and receive alerts about changes. By staying informed, you can quickly address issues and keep your credit on the right track. Identity theft can seriously damage your credit score. If someone opens accounts in your name or racks up debt, it can lower your score and create financial headaches. Regularly checking your credit report helps you spot suspicious activity early and take action to protect your credit. Freezing your credit is a way to prevent identity thieves from opening new accounts in your name. When your credit is frozen, lenders can't access your credit report, making it harder for fraudsters to get approved. You can unfreeze your credit whenever you need to apply for new credit. It's a smart step if you're concerned about identity theft. Credit monitoring services track changes to your credit report and alert you to suspicious activity. Some services are free, while others charge a fee for additional features. These tools can help you stay on top of your credit and respond quickly to potential problems. Negative marks like late payments, collections, or bankruptcies can stay on your credit report for several years. Most negative information remains for 7 years, while bankruptcies can last up to 10. Over time, their impact fades, especially if you build positive credit habits. If you've had credit problems in the past, it's possible to rebuild your score. Focus on paying all bills on time, reducing debt, and using credit responsibly. Over time, positive habits will outweigh old mistakes, and your score will gradually improve. Joint accounts, like shared credit cards or loans, affect both users' credit scores. If one person misses a payment, both scores can suffer. It's important to communicate and manage joint accounts carefully to protect everyone's credit standing. Divorce can impact your credit if you have joint accounts with your ex-spouse. If payments are missed or accounts are not closed, both parties' scores can be affected. It's wise to separate finances and close joint accounts as soon as possible during a divorce. If you co-sign a loan or credit card for someone else, you're equally responsible for the debt. Missed payments or defaults will appear on your credit report and can lower your score. Only co-sign if you trust the other person to manage the account responsibly. Student loans are reported to credit bureaus and affect your credit score. Making payments on time helps build a positive credit history, while missed payments can lower your score. Even if loans are deferred, staying on top of your obligations is important for your credit health. Your credit score is a major factor in qualifying for a mortgage. Lenders look for strong credit to offer the best rates and terms. A higher score can save you thousands over the life of your loan, while a lower score may mean higher costs or difficulty getting approved. Auto lenders use your credit score to determine if you qualify for a car loan and what interest rate you'll pay. A good score can help you get approved quickly and secure a lower rate, making your car more affordable in the long run. Credit card issuers use your score to decide if you qualify for a card and what terms you'll receive. A higher score can mean better rewards, lower interest rates, and higher credit limits. Keeping your score high gives you more options and better benefits. Some insurance companies use credit-based insurance scores to help determine your premiums. A higher credit score can lead to lower insurance costs, while a lower score may increase your rates. Maintaining good credit can save you money on more than just loans. To sum up, your credit score is a vital part of your financial life. It affects your ability to borrow, the rates you pay, and even your housing and job opportunities. By understanding how credit scores work and taking steps to manage yours wisely, you can unlock better financial options and protect your future. Remember to check your score regularly, pay bills on time, and use credit responsibly. With good habits, you'll be on your way to a strong credit profile.